in Uganda, and you're all welcome to our second session on our private equity series. Today's webinar will provide an introduction to valuation tailored for business owners. Before we get started, I would like to cover a few housekeeping items. We are looking forward to an interactive session and encourage you all to submit questions at any point during the webinar. You may make use of the chat window on your screen, and we will address as many of your questions as time permits during the Q&A session at the end of the webinar. Please be advised that this presentation is intended for informational purposes and does not constitute investment advice or a recommendation. You are encouraged to review this information with your financial, legal, and tax advisors. As mentioned, this webinar will teach business owners and other private sector stakeholders on how private equity works. You should be able to understand why and where valuation enters the private equity process, the basics of valuation, and how to value your company and improve your valuation. For today's agenda, we shall have an interactive and simplified deep dive discussion on valuation and the investment process, taking us through how valuation works, with a practical example and an interactive discussion as mentioned in the Q&A. For those of you who were not with us for the first series on Introduction to Private Equity, Renew is an impact investment firm founded in 2012 and has grown to be a leader in impact investing in sub-Saharan Africa. We have 3 business units. We have the Angels. This is the Impact Angel Network that has a membership of over 160 families, mostly from the USA. The second unit I'll talk about is the Holdings, also known as Orange Symphony. This is a $50 million holding company. Renew invests for and manages investments made by these 2 units, made by the Angels and from our holding company. With the third unit, which is the Exchange, to ensure and support the market from which investments for the Angels and the Holdings are made in Ethiopia, Uganda, and Rwanda, we have that Exchange. This is a grant-funded market-building platform that trains SMEs. We have the PE 500 that teaches how investing works, and this session does fall under the PE 500. We have the Execs program that is tailored to train CEOs of SMEs in sub-Saharan Africa, especially in Ethiopia, Uganda, and Rwanda, and the CFO 100 that trains CFOs. All these 3 units work together to create a positive impact on economies in which we operate through increased job creation with gender equality. For those of you who have the Telegram application on your phones or on your computers, you are welcome to join over 1,000 businesses in our Orange Business Network. This network provides support and tips that will be helpful as you grow your business. I would like to introduce a poll. My colleague Phil Setter will launch a poll on valuation, and this will enable us to gauge the room and where we do stand with regards to valuation. Phil Setter, please launch the poll. Thank you for your responses for the poll. I can already see that we do have some questions coming in. We will be able to respond to those in the Q&A session. You are all encouraged to share your questions. I am delighted to introduce to you our instructor for this session, Matthew Davis, who is our managing partner, CEO, and investor at Renew. He is based in Ethiopia, Addis Ababa, where we are headquartered. Matthew has a wealth of experience in investment and operations in SMEs and startups across Africa, and has overseen multi-million-dollar projects on the continent and in Afghanistan. He is best placed to share with you on valuation this afternoon. And with that, I would like to welcome you, Matt, to take over. Thank you.
Thank you, Marion. It's a pleasure to be here. I was quite flattered by that picture that you put up there. I mean, I have quite a bit more gray hair now these days, but it looks like we have a good group of people today. And this topic is quite an interesting topic. We get a lot of questions about it as investors in Ethiopia and Uganda, and soon hopefully Rwanda. And what we have found through the years is that valuation really, when it comes down to it, is a science on one hand. There's lots of numbers, there's calculations, there's spreadsheets, there's all this very intense work that the investment firm does. Or if you have hired an investment bank or a broker, they might go out and do all this work and come back to you as a business owner with these fancy spreadsheets and all of these numbers. So it feels like there's a lot of science involved. But as you can imagine, what I'm about to tell you is that there's a lot of art also involved with valuation. So I saw somebody posted a question about, well, why can't I just be a gut feel about what the value of my business? Well, you know what? Sometimes it is. Sometimes that is exactly what it comes down to. And what we're going to walk you through today is that really the most important thing to know when it comes to valuing your business, which for many of us is the most valuable asset we have. At the end of the day, it really comes down to a negotiation. And there is no exact number that is the right number or the wrong number. It is a back and forth deal that is made between a buyer and a seller. And so when we can kind of step back and take a deep breath and say, oh, really? So there's no right answer? No, there's not a right answer. But what I want to take you through today is there is an approach that is used. In that approach, there is a general approach, a right approach that you as entrepreneurs should understand, especially if you are interested in going out and raising money from a private equity investor. But either way, the most important thing to know is that it is a negotiation and there is no right number. Now, if your shares of your company were trading and exchanging hands very quickly all the time throughout the day, millions of people were buying and selling, then the reality is that you could actually pretty confidently go and get a price of your business. And this is exactly what happens on almost every public exchange when a company goes public. We just learned about some major IPOs from Airbnb and DoorDash, some of the biggest IPOs in history. Well, what happens is when these private companies sell their shares, then there's millions of transactions that happen all the time. And to ensure that there's transparency, the numbers are posted. And you can actually, if you were a company that was trading on a public exchange, you could go and wake up in the morning and grab a cup of coffee. So long as it's past the opening bell, you would open up your screen and look and say, what is the value of my business today? And every minute or so, it will change up and down depending on the supply of your shares in the market and what people are willing to pay. On the other hand, though, especially in Africa, the volume of deals that go up on a public exchange and just the sheer amount of trading that happens means that there's just not a lot of activity that's done in this part of the world. And so most of the equity investing that is taking place is private. And because it is private, it's a dark art. Many people don't understand it. It's confusing. They're using all of these terms I've never heard about before, and that is what we're going to try to shed some light on for you today. Now, today's about valuation, and hopefully you've all attended our Private Equity 101 training, or PE 500, as Mary was talking about. So I'm going to assume you're pretty aware of what private equity is. And very simply put, I like this slide. It's a very nice picture. It describes the difference between two major types of financing that you as a business owner in the middle can go out and get. So a lot of you are probably aware of debt. Debt's very straightforward, very simple. You either have the collateral or you don't. And if you have the collateral, you go to a bank, you apply for a loan, they check the value of your collateral. So long as that collateral is more than the loan that you're asking for and it's not being held by a lien on some other loan, you're going to get money. And the payment is fixed. There's a very straightforward calculation that's done, and every month you pay. And the risk is fairly low because if you default, they'll just go take that collateral, that asset, and then liquidate that to recoup their loss. And that's how it works. However, on the other side of this is equity investing. And equity investing, this is a crash course. But instead of collateral that you're giving in exchange for capital, here you are giving equity, shares of your company. And one way or the other, when and if you decide to go out and raise equity financing, you should absolutely know that equity financing is riskier. Why? Because the payments aren't fixed. They're variable, they're dividends, they're dependent on the value of the shares. Do they go up or do they go down? There's many things that go into determining that. And so you as a business owner, say you're needing to go out and raise $2 million because you want to go buy a new warehouse. The question you need to ask is, how much of the company am I willing to sell, or do I need to sell to get that investment that I need? And most importantly, what's the future upside that I'm giving up in exchange for this money today? So those are very real business questions that you as an owner are going to be faced with. On the other side of that table is me. Now, the question I'm asking is, how much equity do I need in your business to give up this money that you need and not use it for some other company that I am looking to invest in? So it's similar questions, but it is coming from two different perspectives. You are saying, how much do I have to sell of my company to get that money? And I'm saying, just like somebody that's walking around Mercado or a marketplace, well, maybe I don't want 50 potatoes today. Maybe I want 10 potatoes and 10 tomatoes and 4 oranges. So there is a cost benefit. There is a decision I'm having to make about the opportunity cost. Well, maybe I don't want to put all my money with you. And so that is the reality of what an investor is always facing. How much do I need of your company to compensate the lost potential of me investing in other deals? And you are saying, how much do I have to sell of my business? And what future upside am I giving up to get that money now? And hopefully, by the end of this session, you'll be more aware of how that process works. I am going to be giving you the perspective of what it is going to be like that me as an investor goes through when I value your company. You should be doing the same thing. And so hopefully the end goal and what you'll learn is that if you are ever going out to raise capital, private equity, and you're walking into that meeting more aware, more understanding of how the investment process works and where valuation comes in to the investment process, not only are you going to be ready to have a better negotiation and a faster process, that's important, a faster process, but you'll also potentially get a better valuation just by coming prepared. And that goes right back to the art. You have the ability to increase the value of your business simply by how you show up. That is amazing. So with no further ado, let's go ahead and get into valuation. And first, what I'm going to do is walk you through, well, where does valuation come up in the actual investment process? So here's the investment process. It's 7, 8 steps. Normally I have a step at the very beginning, which is prepare. I deleted that because I'm just giving you the very basic one. But right here, generally there's 7 steps through the entire life cycle of an investment. And valuation really shows up in almost every single step. Now you, as an entrepreneur and a business owner, you are likely going to see valuation for the first time here in the term sheet. That's going to be the first place that you're going to see it. But we, investors, will be using all this time leading up to that discussion to actually come up with the value of your business. And we're doing all sorts of things behind the scene. Like, where are those guys? I talked to them. I went and met with them 2 months ago. They've been quiet. They asked me for all this information. Where the heck did they go? What we're trying to do is we're trying to come up with a valuation of your business. And there's a lot of things we need as inputs for that decision. And often, if things are going slow, the reality is that we're waiting on some information that you might not have provided to us, and we're trying to hunt around to find. Or we've asked you for it, and that email has mysteriously ended up in your junk mail. One or the other, we're trying to find information because we're not yet ready to come and put that number in front of you in the term sheet. And again, we go through this in a lot more detail when we do our deep dive on the investment process. But just so you understand, this could, right here, these first 3 steps, and this is key. I always tell people, the investment process is very much like getting married. You first meet out at a bar, we like each other, then we start to date, and then boom, right here, the term sheet's just like getting engaged, just like me dropping down on my knee and saying, I would like to marry you. Would you like to marry me? And if we sign the term sheet, then we go into due diligence. And due diligence, we're really trying to learn about each other. No skeletons in the closet. I meet your family, you meet my family. We're getting ready for the wedding. And then boom, we close the investment. This is like getting married right here. This is when the money comes into the account. There's a party. People are all excited. People are crying. The life is great. And then boom, suddenly we're married. And this is when things can be a little challenging. We do a whole deep dive on the post-investment process. You should definitely, if you are looking to raise capital from an investor, I highly recommend that you go to that session, because we talk about the realities of what it's like to have an equity partner. And then finally, and this is always a tricky one, we exit the investment. And this is always a hard one for business owners, passionate business owners, to kind of get their head around. Why would you ever exit my business? And that really just comes down to the nature of the investment industry. Banks, of course, they exit the business because you're paying them back every month. And the end of the loan is the term loan. Well, investing is kind of the same. I mean, we have to make that money back because we have to make a return for our investors and give all that capital back. So at some point, we've got to sell our shares to recoup that value. And that happens here at the exit. So the point is that valuation happens at 3 key points. It happens during the negotiated term sheet. That's when you're going to see it. It shows up on the final legal agreements when we actually finally swap money for shares. And then really, we're all busting butt really hard to grow your company and ultimately exit for 3-4 times the value that we put in 4 to 5 years. And that's the private equity game. That valuation is everywhere is the point. But now what I want to do is walk you through kind of, okay, what's the next layer down? How does valuation work? What are the methodologies used? And when do those methodologies really show up in this investment process? So let's clear this. Anyhow, just remember this picture. Try to burn it in your mind because we'll reference back to it a few times. Okay, so now that you understand how the investment process works, that valuation is really done throughout the entire 7 steps, and it begins immediately on the first date. Now I'm going to talk you through how it works. What are the, and this is, by the way, this is a very simplified valuation discussion. Obviously, if we had a long time together in semesters of training and all this stuff, we would go through the more detailed versions of these. But for now, we're going to keep it simple. And here is the key piece here. So first, what does an investor need to begin the valuation process? Well, we need information. And really the most basic information that we need is your financial statements. So balance sheet, profit and loss or income statement, cash flow, that would be great. Yes, we can build the cash flow on our own, but it would be wonderful if you provided those. Ideally, these would be audited financial statements. And we usually will ask for these from you after the first date. So after we meet with you for the first time, we are going to give you, wow, I really like that person. I thought they were pretty amazing. So we'll have a meeting after you leave the office or after we leave your office, usually weekly. There's what's called the pipeline meeting in a private equity firm. And your name will be up on the screen. Usually it's a slideshow. Generally it's somebody that is a new analyst or an analyst at the firm that is running that meeting, or there's a document that they've prepared and sent out. And that is a first screening, is what it's called. And we're looking at your business and we say, wow, yeah, this is quite impressive. You know, I really like the entrepreneur. You'll hear a lot of, if you were a fly on the wall, you'd hear a lot of things like, yeah, I really love their passion. I really love their energy. They're extremely committed. Wow, it's a really interesting business. I haven't seen a deal like this before. Oh, it fits right into our investment criteria. You should have heard about how they were talking about their technology. They're the only ones in this space. So there's lots of, generally there's, for you to go to the next step, there's lots of good things being talked about you. And I always tell this to entrepreneurs, never underestimate the importance of giving a good first impression, because pipeline and those meetings that we're holding, right away, we're automatically starting to develop a value for your business. If you showed up to the meeting late, if we went to your place of work and it was very messy and things were broken and nothing was working and you were late to that meeting and you showed up and you're kind of all disheveled, and when we asked you some simple questions about, well, hey, what were your sales last year, and you had no idea, these would be things that would cause us pause. These would be things that, maybe they're not as ready for us to invest in them, or maybe this deal is a little riskier. There's the word. Maybe this deal is a little riskier than we thought it was. We probably should look into this a little more closely. So right there, when I say the word risk, we're boom, bringing in valuation to the discussion, because risk is a critical component into coming up with the value of your company. But basics, if we like you one way or the other, or we think the business is interesting, you'll get an email or a phone call, or we'll swing over to your office and say, hey, we really thought this was a good deal. We'd like to learn more. Could you provide us with your financial statements? And if you say, well, I don't know you, I don't trust you, no problem. We will often give a non-disclosure agreement, which simply says, hey, here's some information that you're going to share with us. Here's a document that confirms that we will not share this with anyone outside the firm. So we'll sign that, or you can just give us the information, no problem. We're very cautious with any information that we get from a business. We keep it very confidential. And boom, we right away start to look at numbers, which I'm going to teach you how to do in just a second. The next thing that we need, but now this would be after we've looked at your financial statements and we want to really learn more about your business, then we do what's called research. And research generally falls into two categories. There's secondary research, which is us sitting in front of a computer, searching the World Wide Web and trying to find out as much information about your industry, your business, your product, your supply chain, your market, your customers. We are pulling all of this information from all sorts of sources, other publicly traded companies, other vendor information. We're calling vendors. We're doing all of this work behind the scene. And that's called secondary research. Then we'll move into primary research. And this is when money starts to be an important factor, because it costs money for us to do primary research. We might hire a firm to go out and do hundreds of interviews with potential customers. We might go out and meet your customers. We might meet your suppliers. We might meet your competitors. We'll go out into the market face to face, not reading from a computer, and do primary research. Then we're taking all of this data and we're starting to develop what we call drivers or assumptions that go into a financial model. Simultaneously, we'll be coming up with a critical number, which is the discount value or risk premium. You'll see that in a second when we go into the discounted cash flow. And then the other things we'll need is a really good financial model or a financial modeler to help us build one. And then we'll run all of these assumptions, different scenarios. And we spend a lot of time. It usually takes, if you don't give us a financial model, it probably takes us a month and a half to 6 months to build a financial model for your company. Again, why is it so long? It all depends on how ready you are and how prepared you are to give us the information we need. If you don't have anything ready, it's going to take us a really long time. And often you and we might lose interest. So the more prepared you are, the more that you have all of this information packaged beautifully into a business plan and a financial model that you can share with us. And all we're doing is going through and verifying that. Boom, boom, boom. We can get to a valuation, get to a term sheet, get engaged, and start moving into due diligence. So your whole goal, if you're following along, I'm still just right up in here, up in this top area right here. But all of this could take 6 months. If you don't have anything ready for us, we're going to have to do all this work just to get to the first stage valuation. And if you have it prepared, if you've got the information we need, boom, we can move pretty quick on this stuff. Okay, so now let's get into the meat and potatoes, which is what are the methodologies that private equity investors generally use to do a valuation. So the first one, and I think this was the most popular one that you've all used to value your own company, which is book value. And book value absolutely is usually the starting point, but it's not, and I'll share with you in a minute, it's not generally used. It's just the floor of the valuation that we'll use, but we'll very simply do the book value methodology. And what I've seen and observed when I'm working with companies is there's a lot of confusion around equity value and enterprise value. So EV, and we'll talk about that when I go through this in more detail. The next one's the price multiples. So this is simply using a comparable like EBITDA and then finding the price of that company, finding the EBITDA, coming up with a multiple, and then using that multiple on your own company. And I'll teach you how to do that. But by far the most complex one, almost always used with startup companies or small companies with very little track record, young companies, new companies, fast-growing companies, and the one that will ultimately really be the one that is put forward to the investment committee, and that for most funds have an investment committee, is what's called the discounted cash flow methodology, or DCF. So what I'm going to do now is go through each one of these with you. I'm going to try to give some light examples along the way, but then we'll, at the end, wrap it up with a kind of a case study example where we'll go through it in more detail. All right, so let's do the first one. So book value, this one's pretty straightforward. I mean, it is what it is. It's the book value of your business. So how it works is first you find the equity value on your balance sheet. Pretty straightforward. You determine if there's any major risks that could impact the company's reputation, if there's major competitors coming, if they just lost a big contract, if their supplier just went bankrupt, if their customer just went bankrupt, if they've got way too much leverage. And then we add or subtract from that. So somebody asked about goodwill. Well, goodwill is actually something that happens after you've received an investment and becomes a line item on your balance sheet, which is above par. And so if we gave you a value of your business that's above the book value or equity value or par value, then it would go on the balance sheet as an asset and is generally called goodwill. So what people hear, I hear a lot is people, what about my goodwill? Well, your goodwill is negotiated. I mean, it's not a calculation. No matter what people tell you, again, there's no exact number that is the right valuation. It's always a negotiation. But ultimately what you'll be finding is that whatever the value is that you end up at that is above your book value or par value, whichever one that you're using, generally if you're plowing back profits and then your par value is going up, that premium would be logged as goodwill. Again, this is rarely used, and it may establish a starting point for an investor. And here, I'll give you a quick balance sheet. I give you a quick balance sheet, and here, so what is this? 770,000 right here. So balance sheet is assets up here, liabilities and owner equity down here. So it's balanced. So this is the assets of the company, and they're financed by debt or by equity. So that's what a balance sheet is set up as. Anybody can tell me what this figure is, 770? Any guesses? Anyone want to chat the answer? Is that the value of the business? Does anybody know? Equity, okay. Anybody else have a guess? Enterprise value, great, yes, exactly. This is the EV. So there's two terms, and some people get caught up in this. There's the equity value, which is actually right here. This is the enterprise value. And so I've actually seen term sheets written by very sophisticated investment funds working with very sophisticated companies. And there was confusion in the actual term sheet during the negotiation about whether they were referring to the equity value of the company here or the enterprise value of the company, which is right here, which is the debt plus equity. So here's the debt, here's the equity. So 481,000 plus 289,000 is obviously 770. So those two add up, but don't get caught up. Make sure when you're reading a term sheet, ask, is this the equity value or is this the enterprise value that you're referring to? Generally, EV is the enterprise value, but you never know. You got to just double check because sometimes that gets confusing. But anyhow, the point is this is the value of the entire business. What you would get if you were to sell the whole thing, you would get this one, the equity value right here. Sorry, my pen got a little out of control. But it would be that equity value, because the bank has their right to their liabilities that you are accountable for and you have to pay off. So that's how book value works. It's pretty straightforward. It's not too scientific, and frankly, it's not always used. I mean, it's rarely used. Again, it's a starting point. We're going to quickly look, as an investor, we're going to quickly look at your balance sheet immediately. It's one of the first things we'll look at. But it's not likely what we're going to come back to you with unless you are a distressed company, unless you are really struggling and almost on the verge of bankruptcy. Well, then, frankly, you're probably going to be getting quite a bit less than your enterprise or your equity value. In a distressed company which has too much debt and is on the verge of bankruptcy, often shareholders are going to get quite a bit less than what their par value or what they originally put in. Okay, the next one is the multiples method, so price multiples. This one is used quite often, not only on the early side of the investment, but in the grow period of the investment process. This one right here in the grow 6 stage, doing the price multiples is probably one of the most common ways that private equity funds are valuing their portfolio all the time. Why? Because private equity investors are constantly trying to show to the world that the value of their portfolio is growing so that they can go out and raise more money. And if they struggle to do that, or if that portfolio is not growing, then they struggle to get money. So their goal is to constantly be, if you ever get a private equity investor, they'll be hounding you every month or at least every quarter for your financial statements, because they want to constantly be evaluating the value of your business. And how do they do that? Well, how they do that is pretty straightforward. First, investors look at other companies that are like your company, either in a public market or they have some ballpark multiple that they use from a recent private equity deal they have done. I'll give you an example here in a minute. They ideally find a comparable figure, something like EBITDA, which is the earnings before interest, taxes, depreciation, and amortization. And this is a common number. You should have this memorized. If you're in the finance industry, you should know exactly what this is. And if you're a business owner, you should know what this is. This is found on your income statement. Very simple to calculate. You just go to the net income, and then you start adding back to the net income taxes, you add it back. Depreciation, you add it back. Any interest, you add it back. And you generally don't have this, but amortization, you add it back. So you add those numbers back to the net income, and that's your EBITDA. And why do investors love this darn number so much? It's like a clunky to say, it looks stupid. Why do we care so much about it? Because it's a proxy for cash flow. I mean, we're lazy. At the end of the day, we just want to look at a number real quick and turn around and sound fancy and tell people, yeah, my EBITDA is $40 million across my portfolio. It's like, wow, pass the cigar. But what we're trying to actually say is, this is the amount of cash that is flowing through my portfolio every year. And if they invested 10 million and their EBITDA is 40 million, wow, well done. That's pretty good. That means that they're generating that much cash. So it's a quick and dirty way to do cash flow, but it's a critical number and everybody uses it, and the private equity industry loves it. So learn it, memorize it, Google it, watch videos about it. People will take you through a fun, go to Investopedia and watch a great video on it. You'll get what I mean. But anyhow, what they're going to do is they're trying to find a number, which is usually EBITDA, and the enterprise value. Don't worry, again, I'll take you through an example of this. They then divide the value by that figure, and they get a multiple. Okay, so this is the key thing, this multiple here. That's what we all want. And then they multiply the multiple by your figure. So your EBITDA. All right. So if that's a little confusing, I will walk you through a good example right here. So often this is what is used if you're an existing business at the early stage of the investment process, and most definitely for all companies during the growth stage. Once we've gotten married, we're going to use this number a lot. So let's go through an example, fun example. All right, so there is a company that is just like your company that is trading on the Nairobi Stock Exchange. You're gonna have to do some math, so I'm getting ready to ask you guys, and I expect you to chat your answers here. There is 1 million shares outstanding. All right, so 1 million shares outstanding. And the shares are trading at $1 per share. So there's a company just like yours, 1 million shares float on the exchange. Let's just assume all shares are traded. There's nothing that's in the treasury. So all of them are out. $1 per share. The value of the business, is $1 million. Okay, so that's not the question, obviously, I was going to ask you. The reported EBITDA, there's that damn letter again. What is that thing? EBITDA is $166,000. Okay, so $1 million value, $166,000. Okay, so first question, what is the EBITDA multiple? Who can tell me? Who wants to chat? What is the EBITDA multiple? Okay, here they come. Yeah, okay, good, close, yeah, 6. Oh, somebody was clever. They said 6.5. Okay, what is the EBITDA multiple now? I'm going to ask you, so the answer is 6. 6.02. Now we're getting some really smart technical people. Great. Now you're right. So it's generally speaking, let's just, I was just wanting you to do some rough numbers. So if I did 1 over 0.116, sorry, 0.166, yeah, it's going to be 6. Now I have a question for you though. Now this is important. Your EBITDA is $100,000. What is the value of your company? Who can tell me? Okay, 600,000. 600,000. Think. What is the value of your company? Think. Yes, this is a bit of a trick question. Normally, I'm just like you, Brian and Varun. I would have answered 600,000 immediately because I love to get answers out there. And yes, technically, the answer, right, Beza, is 600,000. But what is the real answer? Real answer is you don't know. It's because 6x is the multiple for a liquid, publicly traded company. Your company is a private company. Your EBITDA is lower than that company's. So the answer, the correct one, and again, this was a trick question, but the answer is actually probably something more than, I'm sorry, probably something less than 6 times EBITDA. It might be 5. It might be 5.5. It most certainly likely won't be more than 6, especially if this is a company just like yours. If it's a company just like yours, but that company is a publicly traded company, meaning it's liquid, and yours is private, your multiple, just because of the liquidity premium, is going to be lower. So I actually would say the right answer would be something likely below $600,000. That would have been, it's a trick question. Everybody, you had perfect answers, was beautiful. But that is the point I'm trying to make. So that is how really we initially do valuation on your business. We pull up in that income statement, we go down. If EBITDA is not there, we quickly calculate it by taking the net income and adding back taxes, interest, and depreciation. We have some number. That number we have in private equity firms, we also have these numbers kind of in the back of our pocket. We know, okay, well, if it's a manufacturing business, that's 6.5 EBITDA. If it's a tech VC company, it's 2 times sales. If it's a this, it's that. So we try to, and by the way, I'm just throwing numbers out there. Don't ever hold me to that number and say, well, Matt told me. No, but the point is that most private equity firms have these numbers that they spend quite a bit of time going out and trying to gather so that they can do these calculations quickly. Why? Because time is money. And they don't want to spend a lot of time wasting your time and wasting theirs. If your valuation is $50 million and they're coming in, it's something around $5 million. So the goal is to get to that term sheet fairly quickly and ideally create a win-win. And now I'm going to take you through discounted cash flow, but first, Phil Setta is going to run another poll. Phil, show us the poll. Please take 4 minutes to complete this poll. Two more minutes to complete the poll. 2 minutes. All right, 30 seconds to wrap up. Okay. Thank you very much. This information is helpful for us. It's all confidential, don't worry. We're just trying to understand the demographic of the stakeholders we're serving, as well as the impact of a variety of events that have happened over 2020 on your company. So it's valuable for us so that we can make sure that we're serving our community well. Okay, now we're going to move on to the mother of all valuation methods and the most complicated, which is the discounted cash flow methodology. So there's three important concepts that you should be comfortable with when approaching the DCF method. This is the one, by the way, that you're going to use Excel. Generally, you're going to use Excel, unless you're a publicly traded company and you can have a fancy calculator and kind of do the numbers pretty quick. But generally, this is the one that you're having your financial modeler really work on. The three things that you need to know, and it's pretty basic stuff actually. It's way, well, I should tell you, it's actually a lot, the math is a lot easier than you think, but actually getting the right numbers is what's really difficult. So the three concepts are risk, time value of money, and cash flow. And I'm going to go through each of those with you right now. So first, risk. Bottom line here is that risk is uncertainty. In the investment world, if something is uncertain, if your revenue is up 1 month and down the next, up 1 month and down the next, up 1 month, that is uncertainty. If your profit is up 1 month, down the next, up 1 month, that is uncertainty. Thus, your risk is going to be higher. The more uncertainty, the more risk. If you're a new company, that's uncertain. So it's more uncertain than an established company that's been around for 10 years, that has audited financial statements, and that doesn't come and say, well, I have 3 books, one for the auditor, one for the government, and one for you investors. So more uncertainty equals more risk. And here's the key: more risk, then higher the discount rate. And a higher discount rate is a lower valuation. So you'll see when I actually get into the math, this is huge. And back to when I was describing that the valuation is an art and science really comes in because we are evaluating you. I mean, you are such a critical part of the success of a company. You know, one thing, I travel around the world quite a bit, I used to, and I would tell people about investing in East Africa. And I say, I know you hear about all these fancy tech companies and fintech and ed tech and logitech and blah, 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 blah. But there's lots of really great, just simple companies that are making bread and doing landscaping and just really just, you know, your run-of-the-mill great businesses. And don't forget, in your country, German, French, UK, American, in your company, those were the businesses that really built the foundation of this economy, and people made millions and billions of dollars doing that. Those are great businesses. And then the next question is to say, okay, well, you just said that the sector risk is low because tech is very risky, but a very solid company like a bread company, that's very, you know, that's a consumer good. What about the management? And that is really, in this part of the world, management is such a critical thing. So back to the art of valuation. If you are late to meetings, if you're unresponsive to email requests, if you are generally walking in with an overly confident machismo or machismo attitude, it can be a turnoff, and we hear it a lot, and we discuss this a lot too among other investors, that your risk as a manager, it goes up. And it's this thing here, the management risk, that will kill a deal. Yeah, country, okay, sure, there's a civil war in Ethiopia. Yeah, this stuff happens. Sector risk, okay, yeah. The company level, we can invest and fix that. But management, if that's usually going to be the first deal breaker. Now, if you come in and all these other things are not great, but you walk in, you're on time, you have a pitch deck, you stand up, you exude confidence, yet you're humble, you know your numbers, you engage in good discussion, you have a realistic expectation about your valuation, whoa. Then this management risk goes way down, and guess what? Your valuation goes way up. And I'm not kidding, this actually happens. I mean, it is a key piece of the valuation art, is how risky is the management, and will they be able to execute that risk? The bottom of the end of the day, there's a number of things that go into coming up with a discount rate. And that discount rate, you can Google this. So let me see if I can, well, anyhow, NYU does a equity risk premium for East Africa. So you can generally just Google equity risk premium. You can find those numbers online. And NYU, as of July 1st, 2020, was 13.32%. If that goes up to 15%, does the value of your business go up or down? I kind of just told you. As the risk premium goes up, your value goes down. Okay, so there's an inverse correlation between, thank you guys for chatting, I love to see that. Yep, exactly, you guys nailed it. There's an inverse relationship between how risky a venture is and the valuation. The riskier the venture, the lower the valuation. So it's a key concept you should know, and you should be able to build up your own discount rate. Generally speaking, in the private equity industry, in East Africa, we start with 25%. I mean, I shouldn't say that. A lot of people, generally this is the minimum hurdle or the minimum IRR or the standard starting discount rate that we use to discount future forecasted cash flow at the present value in our models. And if you're risky, if your sector's risky, if your company's risky, if you're a new business, this will go up. It might go up to 60%. Generally, it won't go down too much because all of these factors here are somewhat set. But you should know generally 20-25% is the minimum target hurdle or IRR or discount rate that a private equity firm will start with to come up with your valuation. Let's dive into that a little bit more now. So the next concept is time value of money. I think we all know this. You know, $10,000 today, if you have a good friend and they come and say, hey, can I borrow $10,000 from you? You go, yeah, okay, sure. When will I get it back? And they say, I'll give it back to you in 10 years. You're like, whoa, wait, what? No way. I mean, you're not just give me 10,000. I mean, you're gonna have to pay me more than that because the time value of that $10,000 10 years from now is going to be able to buy me a Whopper. It's not going to be worth much, especially if it's Burr or shilling. So the time value of money theory is always very straightforward. A dollar today is worth more than a dollar tomorrow. And that's due to just inflation and then general price increases. So the third piece is cash flow. And cash flow is really where the financial analysts will spend most of their time building the financial model. So the timing of the cash flows when they hit and the discount rate or the risk are just numbers, and then the time. But this is really the hardest part, which is forecasting the future cash flows. And how they do that is that if you're an existing company, they'll essentially take all of the historical numbers and they'll suck those out of your PDFs that you have given them, and they'll hard code all of those into a spreadsheet. And then they'll use that for kind of building out a whole bunch of numbers and ratios that will go into a dashboard. And then they'll start to extrapolate into the future based on interviews with you, that primary research of going out into the market, secondary research, all that research they're doing at their computer. And they'll start to construct and build a financial model. And that interview that they're having with you, ideally you've put that into a business plan or a growth plan, is trying to understand, okay, how is this company going to grow in the future? And the takeaway from this is that estimating cash flow is extremely hard, especially if you have a short operating history. If it's very difficult for us to identify what the costs of your products are. One thing we see all the time is that people recognize costs improperly. So they're not doing a true cost of goods sold. There's a lack of quality data about the market. There's too many books. We hear that all the time. Oh, I got these books, and yeah, but let me show you my real books. Like, don't do that. That's going to make it really hard for us. And there's weak research. So it's usually, if you hire a broker, one of the frustrations that we have is that they often are just cutting and pasting your building you a pitch deck and a financial model that they use for 15 other clients. And so you really need to know those numbers. You really have to look at those, because we're going to use those numbers as well to come up with the forecast of your cash flow. So let me take you through a little quiz, and then I'm actually going to go through a full example with you. So first, let's look at these numbers. And for those of you who have been through the Private Equity 500, you'll know the answer. This is a little bit of a trick question. But just looking at these numbers, which of these two companies, Value Incorporated or Volume Incorporated, is more valuable? And these are the earnings or the net income forecasted over the next 5 years. Which one is more valuable? Who can tell me? Just look at these numbers. Yes, same numbers. Which one is more valuable? Nobody wants to guess? Oh, we got a guess. Here we go. They're the same. Yeah, they're the same. Any other one want to guess? They're the same, right? Yes, based on this information, and this is a trick question. They're the same, and this is the point I want you to understand about the discounted cash flow valuation methodology. It is not based on net income. It's based on cash flow, and this is something that we see companies and analysts get wrong all the time. Now look at the numbers. Okay, now just based on what I just told you, look at those numbers. So we have value up here. Now, what is this net investment? What is this, Matt? This is the amount each year that has to be reinvested in the company to be able to actually hit those earning targets. So we have 100,000. So again, the earnings are the same, but value, I have to put 25, 26, 27, 29, 30. And therefore that gets sucked out of my net income. And what's left is my cash flow. Now there's that number. Now down here, volume, for me to hit 100,000, I'm sorry, for me to hit 100 in net income, I have to invest $50. Wait a second. Now tell me which company is more valuable. It's in the name. Obviously, I'm sure you guys understand. No, it's value. Value company is more valuable. Yes, because it is the company that actually has more retained earnings at the end of the year than volume. You don't have to be a finance person to say this. What I want you to say is that for every $100 of earnings that I have to generate, I have to invest $25 a year. And then that company over there, for every $100 of earnings, they have to invest $50 a year. But just by saying that, you should understand exactly the value is and so it's this number that investors are trying to find. And this number is extremely hard to calculate. And this number is extremely hard to calculate. So a lot of the time, we're in these meetings late into the night, early in the morning. I've got spreadsheets up at my home office, 2 screens up. So you ever see those movies where those people have 15 screens up around? Well, it's because we have spreadsheets, the same spreadsheet on all of these screens, and we're sitting there changing that number and changing that number and seeing how it impacts things. And at the end of the day, we're trying to build our best estimate of a model. But at the end of the day, it's still just a guess. And coming up with these numbers is extremely hard. So the more you as a business owner can give us accurate historical financial information or an accurate business plan in an Excel version of a financial model, the faster you will allow us to move through that investment process and get to a term sheet to make a decision with you. Because ultimately, this is where we're going to spend most of our time trying to come up with a valuation. We'll do a quick and dirty back here when we do our multiples. This is going to be a quick guess, but this one, the DCF, is actually going to be where we spend most of our time. This is the big financial model that we build. So investors first have to do a lot of research. We project the future cash flow, not the net income, the cash flow in a financial model. Then we discount that cash flow, which is both dividends and the terminal value, back to today. Then we sum up all of those and we have your value of your business. And so you can literally copy and paste. We have a spreadsheet. You can do this yourself. It's this is like, it's high school calculations, but actually coming up with these numbers accurately is the hard part. The math is super easy. And for those of you who took really any basic economics course, all of these terms, present value equals, should all know this, future value over 1 plus the risk premium raised to the n. Sorry, my ugly writing. But that is what all of these values are right here. So 75 is the future value divided by 1 plus 0.25 raised to the 1 equals 60. 78.8 divided by 1.25, the discount rate, raised to the 2 is 50.43. So notice these numbers are getting smaller and smaller the further out you get. And the terminal value is also a calculation. And again, you don't have to worry about it too much, but it is the terminal value. This is when we exit the company, is the cash flow in the final year. Yes, you can Google all of this and you can watch great videos. Don't worry. My ugly writing, there's much more gracious videos about this, over R minus GR. Okay, just doing this because I like the fancy tool. So the terminal value, it's not TW, it's TV, is right here. And that's what we think will exit the value of in the last year. So we take 91.2 times 1.25 divided by 0.25 minus 0.5. And we come up with this large number, and then we discount that back using this equation, the present value equation, to get 156.89. We sum up 156 plus 60 plus 50. So this is a spreadsheet, super simple, but I want you to see it's actually not difficult math. It's time value of money calculations, and you just are plugging it in. But to actually come up with these numbers here is why private equity people get paid the big money, because they have to be wicked smart. They have to go out and find out this information. Heck, most of the time we end up knowing more about a company than the owners do because we dive so deep into it. So my point with this whole thing is I want you guys to know we're doing a lot of work behind the scene to try to understand your value. If you do that before you come meet with us, whoo, you're going to be way ahead of, first off, you're going to be way ahead of a whole bunch of other people that come to us looking for money. And you're going to be ready for that negotiation. And it's going to go really fast, really smooth. You're going to know your numbers. You're going to know your forecast. You're going to feel confident. You're going to be able to sit down at that table and you're going to be able to say, you know what, Matt? I like the value you gave us. I think it's a little bit higher, and here's why. And I'm going to go, damn, she knows what she's talking about. Let's do it. You know, so that, I mean, I'm exaggerating a little bit, but that is honestly how these things go. Okay, so I just walked you through the 3 general types of valuation. Now we're going to walk through in the next 15 minutes or 10 minutes an example, and then we're going to spend a good 30 minutes just answering questions. Okay, so I'm going to go through this quick, but I really want you guys to gear up. I'm going to open the floor up. I want chats. I want questions. What the heck are you talking about? I'm totally lost. Anything goes. I want to hear it all. Okay, and again, this is very, very simplified. I'm going to try to touch on all 3 of the methodologies, okay? So just sit back, listen. I'm going to go through the example. First, the company is Dawit Shoes. Dawit Shoes is a fast-growing East African shoe company. Last year, they did $5 million in sales and $700,000 in EBITDA. Ooh, there's that number again. Dawit's assets are $8 million with $4 million of debt. Dawit, the owner, surprisingly, is raising $7 million to open another factory. He goes to Mr. Wonderful for the investment. Dawit and Mr. Wonderful's team believe they can sell the company in 4 years for $50 million. Mr. Wonderful owns a fund that invests in East Africa, Asia, and Eastern Europe. Mr. Wonderful likes Dawit, and his team evaluates the company's risk and gives it a 45% discount rate because the company is small, the shilling is devaluing, there is little export potential, and the country is experiencing political instability. Does that sound familiar? Another similar company is trading with an EBITDA of $1 million for $6 million of valuation on the Nairobi Stock Exchange. Okay, wow, we have a lot of information. And the question is, what is the value Mr. Wonderful gives Dawit and his shoe company? So don't worry, I won't ask you, but I'll walk you through it. So let's go through the math. So first off, I want to give you some lingo, and don't worry, you'll get these slides. You can look at this stuff. There's a few just calculations I want you to understand real fast before I actually walk into the numbers. First, the investment amount we said was $7 million is what Dawit is looking for. So that's usually just abbreviated as INV. And here's some lingo for you. The post-money value, or the post, the present value of the forecasted cash flows, and the terminal value, TV, discounted back to the present value at the discount rate, should the investment be made and the forecasted cash flows be achieved. So this is important. Post-money, you're going to hear this a lot. What's your pre-money? What's your post-money? You know, you hear like people throw around these terms when you're out at a bar. Hey man, I talked with a venture capital firm. They want to know what my post-money was. Like, yeah, okay, whatever. But you want to get comfortable with these terms, post-money, pre-money investment. So I'm going to walk you through these calculations. That again, the post-money assumes that the investment came in And then it forecasted out into the future, and then it used that DCF method that I just discussed, brings all of those forecasted cash flows back to the present value, okay? And that's the value, okay? That's your post-money valuation. Your pre-money valuation is what the investor is, post-money minus the investment. Okay, so it's that post-money that I just talked about, the DCF, minus the investment. And then how much, back to the opening question I asked you, how much does Dowett have to give to the investor is calculated by taking that investment amount and dividing it by the post-money. That is what the investor will own. So what Dowett is giving up is that amount. That's how much equity that guy is now, or that woman is now going to own. So don't worry, you can go back and look at this. And again, watch a YouTube thing, go to Investopedia. There's really great stuff. I'm just giving you the broad strokes here. But let's walk through the example. Okay, so first, let's go through our 3 methodologies with Dowett's shoes. Okay, so first off, who can remember, here, I'll put it up again. Who could tell me what the book value is? The book value method. And I want the equity value. This one's the simplest one. Okay, I see a couple coming in. Any guesses is fine. Good. There's no wrong answers. This is just we're just having fun. Okay, so the book value is right. It's 4 million equity value, 8 million enterprise value. But again, don't worry about this methodology. It's rarely used. This is what banks use. Okay, banks use this book value. Rarely do private equity investors use this. Again, only if it's a distressed asset or a company that is in bankruptcy will they kind of use this. But this is, and I was just shocked when so many of you are using book value. It's probably because so many of you are from Ethiopia or East Africa or Uganda, wherever. And the only way that you ever got any feedback on your company was when the bank said, well, I can lend to you on book value of this amount. But that is, again, rarely used by a private equity investor. All right, let's move on. The multiples method. So what is the value using the multiples method? So let's go back. So what do we have here? Okay. Well, we have, we see his EBITDA. So his EBITDA is 700K. And then I threw a bullet right at the end. So who wants to tell me what the multiples value gives Dowett? Okay, we got 8 million, 4 million. I tried to make the math simple here. So if we've got a 1 million EBITDA with a company that's trading for a total value of 6 million, yeah, okay, 7.14. Okay, so the answer for this one, again, is a trick question. It's 700K times what? Well, again, Dowett is a private company. Dowett is a private company. But if we want to just be real practical with it, we could say, okay, fine. Dowett is doing, what did we say Dowett's revenue was? Dowett's revenue was 5 million. He's doing 700,000 EBITDA. This company's pretty darn close on the Nairobi Stock Exchange. They're doing 1 million EBITDA. Okay, let's give Dowett 6 just for the fact that Mr. Wonderful really likes him. So in that case, the value for Dowett using the multiple method would be 4.2 million. That's 700,000 times 6 equals 4.2. So if you want to do this yourself and go home, call up your accountant, say, hey, what's my EBITDA for the last 12 months? Tell me what my EBITDA was, because you want a full year. Sorry, I should have told you that. You want a full year. Sometimes people will take 3 years and add those up and then divide by 3 to get the average. But just for simplicity's sake, call up your accountant or call your CFO. What's my EBITDA? Oh, your EBITDA, Mrs. So-and-so, is 20 million birr. Okay, so I'm in Ethiopia, so I'll use birr right now. Divided by 38, that's $526,000. And because you're in the manufacturing sector, just go ahead and multiply that by 6. 6 is a roughly good EBITDA multiple to use to give you a ballpark number. Sometimes it's going to be higher for the sectors, for the stage of your business, for the maturity, for how amazing you are. Sometimes it's going to be lower. But generally, rule of thumb that we'll use here in the old private equity world, we'll use something like 6, 5, depending on what you're at. So that would give that would give you a 3.1 million valuation. So you could do this all yourself. But that multiple, that is the key piece. And so you really want to hunt around and find that multiple. All right, now we're going to get into the DCF. And I simplified everything for you. So back to Dowett. We said, okay, we know that the terminal value 4 years from now is going to be, we're pretty confident is going to be $50 million. We also know that we're really not going to be kicking off any money because we're going to be reinvesting all of that money into the business. So there's no dividends. The discount rate's 45%, given where the company's operating and just what it is. And we have year 4 here. Boom. And the investment is $7 million. Okay, so we have everything check, 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 and check. We have everything to do DCF. Great. Let's do it. So back over to our example. So the post money, again, is the present value of $50 million at a 45% discount for how many years? 4 years. So you simply plug that into a very simple calculator. You do 1.45, that's 1 plus 0.45, raised to the 4, the years, and then you take 50 million and divide by that number. Holy crap, look at that. Look at that, how you're telling me $50 million 4 years from now is only worth $11 million today? Yes, because Mr. Wonderful really wasn't very wonderful to Dowett, was he? He gave him a 45% discount rate. And by the way, that's actually pretty good for this part of the world, for the country that he's operating in. Because don't forget, Mr. Wonderful's looking at companies in Eastern Europe. Mr. Wonderful's looking at companies in Asia. Mr. Wonderful's looking at companies in other parts of the world. So you've got to make sure that you're comparing all of these and giving them an accurate view of the opportunity cost of what he would do if he's looking at other deals. Now, what's the pre-money value? Who could tell me? Real quick, what's the pre-money value? You should do this now, right in your head. Remember, pre-money is post, which we just calculated, minus the investment. The investment, 7 million. So it's 11.31 minus 7, boom, 4.3. Yep, there it is. Now, how much ownership is Mr. Wonderful going to take of my business? Now, remember, it is, what is ownership? It's the investment amount over the post money. So 7 over 11.31. And that is 62%. Mr. Wonderful, you really are taking a whole bunch of my company. Well, yes, Dowett, we are. And so that is how all 3 methodologies. So we got a 4.3 million valuation. We got a 4.2 million valuation using the multiples method. And we got a 4 million equity value. And that actually is kind of how it works. Private equity firms will do all 3 of those and they'll look at the numbers. Generally, they'll go with this one because it's the most rigorous. But often they're not too far away from each other. Okay, I promised you 30 minutes of Q&A, And I'm going to shut up now because I want to hear questions from you. So I'm going to turn it over to Mary. I want you all to start posting your questions in the chats. Any question you have. We covered a lot of material. This was a crash course, but let's hear what questions y'all have now.
Thank you, Matt. As Matt had mentioned, and please feel free to share any questions that you may have regarding valuation. Any questions regarding valuation are welcome.
As people are thinking, I'm going to, I'll give you this kind of closing advice because I think it's important. And then hopefully you're chatting your questions as we're going through this last slide. My encouragement for all of you is to not be intimidated by valuation. It's not as complicated as you think it is. And it is complicated because what's complicated is the quality. It's like making a good meal. The quality of the end product of the meal is the quality of the ingredients that you put into it. The actual baking and doing everything, that's mostly a methodology that's fairly well practiced. You can read all of that in a recipe. But if you've got crappy inputs, it doesn't matter how great the recipe is. If you've got old, poor quality inputs, the end product is not going to taste good no matter what, no matter how specifically you follow the method. So with the DCF method, which is by far the most complicated, all of it really does come down to the quality of the research that's done leading into that. And if you can sit down and give yourself an honest valuation, you will come to the meeting prepared, or the discussion with the private equity investor so much more ready than almost anyone else. And you'll be able to accelerate the timeline, which is always the most thing that people get frustrated with. Matt, why does it take so long? Well, it's because you didn't come and bring anything to me. All of this has taken 6 to 8 months, where in fact it really shouldn't. It should have just taken a few, like a month. But the problem is that that's not how it generally goes. So, all right, back to the closing advice. I think we've got questions coming in. My recommendation: increase the value of your business. Show up strong. Try not to be emotional when you're doing your valuation. Know the investor you're meeting with. Have that business plan and the financial model ready. Be realistic about the risks. Be responsive to requests and practice. And you will definitely get a higher valuation. So, Mary, go ahead.
Sure. The first few questions, I will group those up in relation to co-founders. What methodology should a solo founder follow if he or she finds a partner somewhere down the line post-revenue? They're referring to a co-founder share. And Victor asks, do you need a co-founder to be more credible?
That's a good question. So when you say a co-founder, you mean, okay, so say you have a new company, you've been working on it, you're Steve Jobs in Menlo Park, and you're gonna, Steve Wozniak comes along and you want to give him some equity because he's super smart and he's actually the one that has all the technology. Is it that type of co-founder, or is it somebody who's actually coming in with money?
Could we discuss both? But
sure.
I will ask Gashal to clarify in the chat.
Yeah, so I mean, at the co-founder stage, if they're not actually bringing money to the company, well then, what you're doing is kind of a similar activity if it's likely a startup or a new venture. the more confident you are about the future, and then using that DCF, because that's usually the way that a private equity investor will value a startup. They'll do DCF because there's no historical numbers. You could do that yourself and say, okay, co-founder, I don't have the money to pay you a salary, or at least not the salary you deserve right now. You're going to be my co-founder. And usually that is when you're giving equity. When somebody of real high value is coming in to partner with you, and they're taking a haircut on their salary with the hope of a future return. And so you don't have money, so you give them some equity. And so your job then is to look at the salary that you would normally give them if you were a thriving business, or that they would get from the market. And then you look at that just like an investment. So let's say it's going to be $100,000 that you pay them in an annual salary, but you're only going to pay them $20,000. Well, you're going to pay them 80. That's an $80,000 investment. And then there's, in year 2, it's another $80,000 investment, but discount that back to the present value. So you'll look at, just like what we just did, you'll look at what they're sacrificing for a period of time. You'll bundle that up in a value, and you'll say, hey, I'm valuing your time and your commitment. And I did my discounted cash flow of my value of my business to be $1 million. I feel like you're bringing this amount, I'm going to give you 8%. So that is kind of how that would work. It's like, hey, $80,000, $1 million valuation. You're coming in with 80. There it is. Post money, $1 million. Here's 8%, and you give them 8% of your firm. Is that? I hope that's what they were asking. I'm not sure if that is, but yes, that's how I would do it.
Yes. Okay? How would you go about valuing a startup post-revenue?
A startup post-revenue. Back to that one question real quick. I do want to be cautious. Is that you should definitely talk to a lawyer before you give any co-founder equity. And they should have experience in the space and should probably advise you about vesting schedules and buyback options and stuff like that. So one thing that founders often will do is they'll give away too much up front. So just be careful about that. Most venture capital funds will actually require that you carve out a certain amount as an option pool for incoming high value executives to the business. So just think about that. Sorry, Mary, go ahead. What was the question that you asked?
How would one go about valuing a startup post-revenue?
Startup post-revenue. Well, then it's probably, we're going to be looking at the multiples method, and what we would be doing, still probably DCF. So at the end of the day, we're always going to go back to that. We might have a little bit of data now that you're up and going, but it's still probably going to be a DCF. But what we might also do is we might look for companies like yours in other markets that got an investor. And often what we can do is we can look at news articles or press releases, because a lot of investment firms do that, and say you're a hot motorcycle Uber type company, and you're doing 150 rides a day. And so I Google and I find out in Nigeria that there was a motorcycle Uber company like that got a $5 million investment, valuation not disclosed, and they were doing 3,000 rides per day. That indicator, again, it's trying to find a multiple, or they were doing 150 rides per day, so exactly the same as yours. Well, then we would say, wow, okay, well that obviously it's a much bigger economy, it's much larger, but at least we're now looking at some different comparables. And then we would try to kind of factor that in. We might call up that investment firm. We might try to find backdoor ways to get what that valuation was to get those multiples. But at the end of the day, we're still going to likely do a DCF.
We have a good question from a startup company. The startup is currently pivoting and will be going live tomorrow. The founder has been advised that they should not do any valuation so early on. Is that a good recommendation?
Yeah, I mean, it's up to them. Yeah, I think if you don't need capital, I don't know if don't do valuation early is, it might be what the advisor is telling them. They might just be saying, don't go out and raise capital quite yet, because it's always good to show track record. So then the question is, well, how much runway do you have? How much money in the bank do you have to cover your operating expenses and your growth? If you're looking at 7-8 months, so you just take what you have in the bank and divide by your monthly burn, whatever number that is, that's how many months of runway you have. If you don't have a good 8-9 months, you're likely going to be in trouble, because that's about what time it takes to go out and raise private equity capital. So you always want to kind of balance those two. But yeah, without knowing more about the business, it would be hard for me to give a good opinion about that.
Oh, thank you. Brenda, if you could share any more insight on the business, that would be great. A question from Ethiopia: how do you get the competitors' data in Ethiopia?
Yeah, so a lot of companies, what they would do, not just in Ethiopia, but in any company, is you hire a company, or you can do this, or some of your team, and you can be a silent shopper. So that happens a lot. So if you want to understand, well, so it depends on what competitor data you're looking to get. If you're looking to get competitor data on a transaction or an investment that they just received, that probably will be difficult. But if you're trying to get data that feeds into your financial model, which you should always do, then what you would do is, yeah, you would have a silent shopper go and say, hey, I'm looking to buy XYZ services. How much are those? And so you would get then, okay, and then they would just kind of start asking questions and try to get as much data from those companies as possible. And you might want to interview, have them go around and be silent shoppers, silent or secret shoppers. I meant to say secret shoppers. You might want to have them do that for 3 to 4 companies, and then come back and compare their numbers that they got with your numbers. And then that is a way that you can get comps on your competitors. But actually getting valuation data, EBITDA data, all that stuff, it's very challenging. It's almost impossible. So you got to kind of extrapolate that information.
A question concerning risk, the country risk. Our business is really affected by the current country situation. Are you going to consider this situation in your valuation? So maybe throw more light on country risk and the details of that and its impact.
Well, yeah, I think any foreign investor takes into consideration country risk. So like right now in Ethiopia, and to some degree Uganda, we do unfortunately have some political instability here in Ethiopia. We are just slowing down, hopefully coming out of a civil war. Those little things do impact investors' perception, and they increase the risk. Generally, you might not get it so much from kind of a valuation perspective. It might actually impact your timeline. So if you were talking with an investor, 6 months ago, and you were just getting to a point where you were starting to take things seriously, and then what happened in November happened, then that in Ethiopia, then all of a sudden things are going to slow down, and they're going to be like, well, let's have a call next week or next month. We're still trying to figure out what's going on in Ethiopia. So it might not impact your valuation, although it could, but it will likely most definitely impact timeline.
Could you share resources on, you had mentioned during the presentation, how one can know the amount of IRR the amount IRR investors would require, and well, a source for valuation for dummies of sorts to help maybe explore further.
Yeah, there are some really good resources online where you can kind of back into this stuff, and you can just kind of Google what is the valuation of companies, and there's these websites that have kind of these numbers where you can kind of plug in some similar numbers that you have, and they'll spit out a number. I wouldn't trust them too much, but what was the other question, Mary? Sorry, just before that. Oh, the target IRR. Mm-hmm. Yeah, that's a question that you can just ask when you're meeting with an investor for the first time. So some people share that information on their website. Generally they don't, but it's something that they would give. Like for Renew, our target IRR is 25%. And that's our target. You know, do we get those on every deal? No, because we do expect some deals are going to underperform, and we hope some deals are going to overperform. But across our portfolio, that's the target. So do you need to use that number for your discount rate? No. Should you use it as a starting point? Probably. Should it be higher than that so that you are managing your expectations? Yeah. And you can play around with that number and see how your valuation changes in the financial model if you got somebody that built it for you that did a good job. But yeah, I would just ask.
If one's EBITDA is low or negative, but they have a good market for their product, how would you advise on negotiating for investment?
Use DCF. Yeah, I mean, I would use the DCF methodology and say, and hopefully this is a company that is fairly new. If you've got a negative EBITDA and you've been around 10 years, it likely means that you're in a distressed or a turnaround position, in which case we're going to go to the book value and start to kind of, we're not likely going to be giving a big premium over par to buy your company. We're in the process of having to get you out of potential bankruptcy. But if you're a young company with an EBITDA, that go right back to the DCF model. So here's our future potential. We feel like there's a ton of potential. Here are the numbers. Here's the data to back those numbers. We feel confident about this financial model. Mr. Wonderful, let me walk you through this. And boom, 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 that's your pitch. And we love that. But more often than not, you're not coming in the room with that. It's just like, well, I feel. Okay, well, I want $500 million. You know, I have to work for it. So we can't just feel our way to valuation. You have to walk into the room with some logical backing for why you want that valuation. Otherwise, you're going to waste your time, you're going to waste my time. But if you can come in and do your homework, which is my main recommendation, yeah, we can really crush it. We can go through a very good discussion with that.
Who determines the method of valuation of a company during negotiations? And in your experience, do the values from the three methods differ a lot? Which method does Renew use mostly? And how did you arrive at that decision?
Okay, I'll work backwards. So for a turnaround, it's usually book value. For distressed, for a company that has a track record, it's the EBITDA multiple, but then we'll still do the DCF. And for a new young company, it's DCF. We don't sit down with a company in the front end of it and define what valuation method we'll use. It's just what we internally are doing. But I recommend that the company, that's why we're doing this training, that you do your own valuation so that we can make the negotiation quick and efficient and a win-win for everybody. What I often feel is the original question somebody said, why not just go with a gut feel? If your gut is really good, which yours probably is, but I will say that most people's are not. Their gut feel is more emotional feel, and I get it. I totally get it. I mean, this is our baby. This is our company. How dare you, give my company that I've been sweating and toiling over for months or years, that valuation. And well, you know, Dowd, it's because we sat down and we did our homework and we went through the numbers. And as much as we like you, I just don't think that we are able to get the return we need to our investors with that valuation. With this valuation, I think we can. That's what an investor who's probably like walking quietly towards the door and hoping to run out is going to do with, you know, an emotional person that's not doing their homework. But if you can come in and be like, okay, I see where you're coming from. I think the numbers are a little better than that. So, you know, and here's why. And I have the data to back that up. And then we'll argue over that. But generally, if we're both looking at the same numbers, we're generally going to come to the table with the same or very close to the same valuation. Again, the risk, you have to remember that. If it's a foreign investor, they've got options around the world. If it's a Ugandan investor investing in a Ugandan company, they're actually probably going to give you a better valuation because they're in the pot. They know the risks and they're already exposed to that. If it's an Ethiopian investing in an Ethiopian company, they're already in the pot. They know the risk. But if it's an American investing in an Ethiopian company, we could also be investing in Apple or Tesla or Airbnb or whatever. We have all those options. So your deal is getting compared in some ways next to that. And we have to have a really good return, a risk-adjusted return, because it's, while I might only get a 7 or 8 or right now 11% is what people are getting in the stock market return, that's 11% in the safest country, well, it used to be, in the world. So if I'm coming down to Uganda, you really have to put forward a very, very attractive valuation for me to hit my target.
When raising equity, how does one decide whose shares should be liquidated where there is more than one founder?
Yeah, so that will be discussed up front, and it will be in the legal documents when you finally get to closing, but it will be a part of the term sheet. So there's things called drag-along rights and tag-along rights. And so you and the investor will essentially come up and talk about that. But we'll talk about that in the term sheet deep dive. And Mary, you're the lawyer, so you'll be able to share a lot about that. But a lot of those terms are baked into the discussion and negotiation. And will show up on the term sheet.
Do you do valuation again for other rounds of funding after the initial investment?
Absolutely, 100%.
And is the same method deployed, or is that interchangeable?
Changeable, depends on how the company's doing and what's going on. For quick and dirty, we'll do the EBITDA multiple one. That's generally what people are doing.
Okay.
Post-investment.
Okay. Well, we have someone here in the e-commerce resales sector who is planning to compete with Jumia, and they're asking what is the typical valuation in the region?
Good for you guys. Well, you can look at Jumia because they're a publicly traded company. So you can go to Jumia, you can look at their numbers, you can essentially find out what the market value is of that. So all that information is publicly available, and what their EBITDA or their revenue is. And essentially what you could do, well, if this is a startup company, you're going to have to do a financial forecast, which is a financial model. So you're not going to get away with that. But if you're an existing company already, then you can just do what the multiple method was that we used. So you can use sales. So look at what their revenue is and find out what their market cap is. Divide the market cap by the sales, you'll get a number. And then look at your sales and multiply it by that number, maybe a little bit lower, to give yourself your valuation. So Jumia is nice because they're a publicly traded company.
Lastly, back to the discussion of a co-founder. I believe before, when discussing how much equity should be given, there was consideration to a discount of the amount that they will be taking. This question is, if a silent partner has a valuable network and good connections, are they a good fit to be a co-founder? And if so, how do I decide how much of a share to give them? And is business connections alone enough to make them a co-founder, or should they invest money too?
Well, I will right away say I have no idea because I don't know what type of business or sector you are in. But If networks are extremely important to you right now for the success of your company, then likely the value of their network is fairly high. If it's just a nice to have for the company, then the value is fairly low. Again, it's a negotiation. So you have to kind of determine what that will be and what they are willing to take a haircut or no salary for based on what their services are going to provide you. But a little tricky to do. It comes down to a lot of different factors that we don't have time to talk about today, but that's a good question, and we can take that offline and help you think through that or look that up. It's a common question a lot of people have. And I would just, again, as I was saying before, look at what is the value of what they're bringing to the table and how much are you willing to give up for that value? Just like an investor.
Lastly, we have how can we value our achievements? Kindly clarify, but I believe this is referring to goodwill, but how can we value our achievements?
Yeah, I mean, again, at the end of the day, if you've been working at the business for a long time, but the business hasn't done well, that's the hardest piece of it, right? So you're going out to the market. You started the company, you've been working on it for years, you've taken some salary. You know, what about my cut? Well, at the end of the day, it's going to come down to the methodologies we just walked through. That's how we're going to come up with the value of your business. Goodwill is it's a balance sheet item that is put in there after we give you, if you get a value of greater than your book value. And if that's the case, again, there's no way to calculate that. It's using DCF, the multiples, or your book value, the three methods that we use. So you kind of got to go through it that way. I think for some reason in Ethiopia, everybody heard about goodwill and they thought that was the big cash prize that they get if they bring on an investor. It will always come down to these methodologies we talk about. And if you get paid out, then we're buying shares above par value. And so that's, I guess, your premium over par that you get.
Okay. We still have questions regarding the co-founder and how much equity to give them, but you've discussed that is something that we can share to the participants via email. If there are no further questions, that is it for the Q&A.
Thank you, everybody. And Mary, why don't you wrap us up? And I actually have to get out of this account because we got another call started, but I just want to thank everybody for participating. I really enjoyed this. And please stay on. Mary, why don't you take us through the next steps? Thank you, everyone. I had a great time with you.
Sure. Thank you for attending the second session of our PE 500.
Mary, you there?
Yes.
Mary, you there?
Yes, I am. Can you hear me?
Okay, we lost Mary.
Thank you for attending the second session of our PE 500. If you're looking for an investor, feel free to reach out to us. If you are interested in participating in our execs program, this is for the CEOs, also do reach out to us. Before we conclude, we'll share with you a feedback form and would like you to respond to that. For those who would like to reach out to us, we will follow up with a phone call. Thank you. Please note that a link to the feedback form has been shared in the Zoom group chat. Again, on behalf of Renew, thank you for joining us for the second session of our PE 500 on valuation. Wish you a lovely evening.